So allowance for doubtful accounts is a contra asset account. So it increases on the credit side. And we know at the end of every year, we're going to do an aging of receivables under the allowance method, and we're going to calculate our adjustment amount. Okay, we're going to find our ending balance too, right? So let's just make up a number, and we'll say we had estimated that $20,000 this year was uncollectible. You know, that was our adjustment amount. So maybe that was our adjusting entry. So maybe our total balance is like $22,000. Because we already had like a $2,000 balance in here somewhere, okay? So just make an assumption there, okay? So as we know, again, this is what our estimate was, right? When we did our aging of receivables, we got that $22,000. And then we calculated the adjustment. This is what we debited to bad debt expense, okay? So bad debt expense was debited $20,000. Didn't give myself much room there, did I? And allowance for doubtful accounts was credited. Okay. So that's what my adjusting entry looks like under the allowance method. So understand that, okay? Know that at the end of the period, you know, we may have had a $2,000 balance in allowance for doubtful accounts at credit balance. This number came from our aging of receivables. Okay. So when we did our aging of receivables, we came up with this estimate, right? We said, out of all the accounts that we have, we think all total this year, out of those accounts receivable, $22,000 is uncollectible. Well, again, it already had a credit balance, so I subtracted to get my adjusting entry. Okay, so when allowance for doubtful accounts has an existing credit balance, remember you subtract to get how much you're adjusting. So as far as like beyond, you know, the multiple choice stuff, knowing the methods, knowing how allowance for doubtful accounts kind of functions, as far as your hands-on portion for allowance method, you want to know how to calculate this adjustment. Okay. So if I tell you, you know, this was the estimate, this was the existing balance, you need to calculate how much you're adjusting. Okay. So they'll give you the ending balance and the beginning balance. So again, if it's an existing credit balance, you take your estimate minus the credit. What happens if, we'll do it over here so it's not confusing, hopefully. What if they told you your estimate was still the $22,000 and you need to find your adjusting entry, but I had a debit balance of $2,000? So what if my balance was a debit instead of a credit? You would add to get your adjustment amount. Very good. So I would take my $2,000 plus my $22,000. And so my debit to bad debt expense and credit to allowance for doubtful accounts would be $24,000. Okay. So understand how that works. How did I get a debit balance, an ending debit balance, and allowance for doubtful accounts?
Did you have someone less than what you thought you did?
Kind of.
You wrote off more than you estimated you would?
Yeah.
Yes. Yeah. Very good. So if we end up with a balance of a debit before our adjustment, so before we put in this adjustment, we have a debit balance here. That's because we actually wrote off more than what we estimated. So remember, what happens is we come up with this. This is the credit balance after the adjustment. So that's what we start the new year with. We start the new year with a credit to allowance for doubtful accounts of $22,000. And then we still, as we go through the year, say, oh, Joe Black isn't paying, so we write him off. Every time we write off accounts under the allowance method, that gets debited, okay? So again, just kind of, what happens as we go through the year, we start with a beginning balance, which was last year's ending balance. So this is like January 1. We started with a credit of $22,000. After you do your adjustment, you always should have a credit balance and allowance for doubtful accounts, okay? And then it's February 3rd, and we think, like I said, Joe Black, he's not going to pay. Well, we debit allowance for doubtful accounts for the amount that we think he's not going to pay. So that's a debit to allowance for doubtful accounts and a credit to what?
Would you credit that?
You don't credit bad debt expense. Well, we're saying Joe Black's not going to pay. So what would I credit?
Accounts receivable.
There you go. Yeah, you guys got it. Accounts receivable for Joe Black. Okay. And we would just continue to identify people that weren't going to pay throughout the year. So maybe on April 15th, we determined that someone else wasn't going to pay like $10,000. Okay, so we would have another debit to allowance for doubtful accounts and a credit to their accounts receivable. And we would just do this. You did that in that longer problem that we did. We did an example Tuesday, right? Mm-hmm. So you just kept debiting allowance for doubtful accounts every time we deem them uncollectible. Okay. So at the end of the year, you're doing an adjustment estimating how much you think is uncollectible. And then throughout the year, you're identifying specific accounts to write off.
And so you'd add that to 22,000?
No, at the end of the period, then you would balance it. So you would actually take 22,000 minus 15. So that's how you would end up with like a credit balance and allowance for doubtful account before your adjustment.
Okay.
If this kept going, say I had another 10,000 that we wrote off, that would get to 25,000. That's how you get a debit balance. Yeah.
Makes sense.
Okay. So that's kind of the big takeaway on understanding allowance for doubtful accounts. So that's a big part of chapter 8. The only other thing dealing with that, we're going to still deal with a note receivable under 8. But the only other thing you need to know how to calculate under chapter 8 is net realizable value of accounts receivable. Okay? Net realizable value of accounts receivable. It sounds like a lot of words. It's really easy. Well, remember, allowance for doubtful accounts is a contra asset, or contra accounts receivable specifically. So whatever's in here is reducing accounts receivable indirectly, right? So if we said we had 500,000 in accounts receivable, but we think 22,000 is uncollectible, how much do we really think we're going to get?
Minus 22,000.
Exactly. So your net realizable accounts receivable, net realizable value, is just equal to our accounts receivable minus allowance for doubtful accounts. Okay. You just take your accounts receivable balance minus your allowance for doubtful accounts. And this would be after the adjustment. So you've done the adjustment and you're ready to do statements. Okay. So on the balance sheet, you would show accounts receivable less allowance for doubtful accounts. So that would equal how much accounts receivable we really think we're going to receive. Which again is another reason we do this estimate, because that follows the matching principle. Okay. Hopefully that brings it full circle. Any questions on the allowance method? As far as other hands-on stuff in Chapter 8, no, just the journal entry under the direct write-off method. So switching gears, what would I debit and credit to write off an account under the direct write-off method?
Bad debt expense and accounts receivable.
Perfect, yeah. So direct write-off method, journal entry, debit bad debt expense, and credit their accounts receivable.
And there is no adjustment.
Correct. We just do those every time we think someone's uncollectible.
And so this is the adjusting entry for, that's what, I had
Yes.
my only question on Chapter 8, because I was like, I don't know how to. But this is-
Yes,
so I can
only
figure
for
that
the
out.
allowance method. Yeah, only for the allowance method do we have to worry about any of this. I almost said crap. This beautiful stuff.
What was the last thing you just said that I need to write down?
And the journal entry under the direct write-off method is a debit to bad debt expense and a credit to accounts receivable.
So we're not gonna need to know how to do the,
Like percent of sales or,
or interest.
we're gonna do notes. Yeah, we're about to cover,
Oh, is that
Which one?
notes?
yeah, notes receivable.
Oh, yeah, that.
There's just a couple, there's like three or four questions on notes on the test.
So will there be like cost of goods sold that was up on,
No.
because that was on the homework line. I
Yes.
forgot it.
Nice review, right? Like, oh, I forgot we had to do this. Yeah, no, you won't have to do that. But you will need to know a few things about notes. So actually, what I want to do now is we're going to do an example of a note, and that pretty much covers what you need to know about a note. So, switch gears.
Okay, and that's where we figure out how much the knuckle and
So this is in the 8-9 extra practice exercise 4, which is 8-22. So really, to me, the best way to really cover and review notes, we didn't get to do this example Tuesday, so I thought we'd do it real quick. So this is one where we have a note that was written in 2017 that's due in 2018. So we have to account for interest that is accrued in the current period. Again, all matching principal, all adjustments. So let's look at it. So this one says on December 7th, we received from Unitarian Clothing and Bagging on account a $75,000 60-day 3% note. Okay. It wants us to journalize these transactions. So on that first one, when I issue the note, what do I debit and credit to issue a note on account? Notes receivable, good. Yeah, very good. Accounts receivable. So notes receivable gets debited and accounts receivable for Unitarian Clothing gets credited. How much do I debit and credit?
The amount.
Very good. Yeah, the $75,000, that principal amount or the face value. Very good. Okay. So on your test, you will be doing an issuance of a note. So just know when a note is issued, you debit notes receivable and credit, in this case, accounts receivable. And your test will be the same example. It won't be sales. So it'll be accounts receivable. Okay, so that'll be one question. Another question that you might see on the exam under notes is calculating the maturity value of a note. Maturity value of a note. The maturity value of a note is what they're paying you when it matures. So the principal plus interest. That's all it is. Okay. So the maturity value of a note is what they're going to pay you when it matures or comes due. Okay, so principal plus interest. So those are both pretty easy, right? Those two. So then the only tricky one is dealing with interest accrued. Yes, did you have a question?
No.
Oh, okay, you're just stretching, okay. So this one, we wrote it on December 7th, and they already calculated the due date, as you can see, is February 5th. It was a 60-day note. But we know, since it spans 2 accounting periods, we have to, on the 31st of this year, 2017, for December, we need to do an adjusting entry for interest that has accrued that we haven't yet received. Okay? So down here on February 5th is when they're going to pay us the full maturity value, so the principal plus the total 60 days of interest. But we know in this period, in this year, 2017, we have earned interest that we haven't recognized yet. So the revenue recognition principle states any revenues that have been earned, whether we've received them or not, must be recognized in the period. So what I need to do is calculate how many days of interest. So 31 minus 7, right? What is that, 24? Is that right? For some reason that didn't sound, it's like, it didn't sound right in my brain. So 24 days have passed in this 2017. So I need to do an adjusting entry on December 31st to recognize 24 days worth of interest. Okay, well, how do I calculate interest?
Face amount times the percentage. Days over 360.
Very good. Yeah, I would take my face value of 75,000 times my interest rate of 3% times, I want to calculate 24 days only.
Oh, okay.
Because I'm just doing partial interest here. Okay. So how much interest had accrued just from the 7th through the 31st?
$150.
Very good, $150. So that's how much interest I need to record in the current 2017 year. What would I debit and credit to recognize interest that is owed to me that I haven't received yet? Very good. So I would debit interest receivable and credit interest revenue, $150. Okay, $150. Now, I'm going to skip the closing entry because that's not on the test. Okay, don't worry about it. Woohoo, right? So the last thing you need to know, though, is the journal entry when the full payment is received. So February 5th is the maturity date, right? That's the due date, the maturity date. So they're going to pay us the full, 60 days of interest at that point, okay? So at that point, I would want to calculate the total interest due. So 75,000 times 3% times 60 over 360. How much interest are they paying me total on this note?
150 plus their number is that?
375.
Very good, yeah, 375 total. And this was for 24 days. Okay. So all total, the maturity value of this note is 75,000, oops, forgot it now, plus the 375 interest, right? They owe me a total of 75,000 plus 375. So on February 5th, when they pay me, you should receive cash of $75,375. That's the maturity value of the note, principal plus total interest.
Is that all of it combined, or is that just?
Yeah, that's the full 60 days of interest. That's how much they're paying us. They're paying us the full note. And then we always credit notes receivable for the face value, the 75,000. And then what do I do with my interest?
Receivable revenue.
Correct. We credit interest receivable for how much? 150. Because we're paying off, or we're receiving what we had recognized the actual revenue up here, and now we're receiving it. So we're crediting it to say, oh, it's receivable. It's no longer due to us. And then what else do I do? Very good. We credit interest revenue. And in that case, it'd be 375 minus 150, or $225. Or if you want to look at it, the other 36 days of entry. Okay. Any questions on notes? So again, just to recap, you need to understand how, like the first journal entry, just issuance of a note at the face value. How to calculate maturity value of a note, which was the 75,375, so principal plus interest. And then your adjusting entry and receiving full payment. Okay. Any questions? Yes, ma'am.
On the part quiz, there's this question, it's categorized under provided doubtful accounts, and it just gives us a list of things, like before adjustment and the disbalance. Just a list. It's determining adjusting interest, but it's just a list of like. And then it has the spot you use the answer. It does actually It's my number.
This one?
Yep.
Okay.
I don't even know how to.
No, that one will not be on the, you'll have one where you do one balance, but not like several. Okay, so all that's dealing with is it's saying, you know, you're looking at calculating the ending balance of allowance for doubtful accounts and then the adjusting entry, right? So it won't be worded like that. They won't have you calculate it and then do the adjusting entry. But for example, okay, so at the end of the current year, accounts receivable has a debit balance of $1,036,000, sales are $11,750. So A, the allowance account before adjustment has a $14,000 debit balance, and then it's telling you what the bad debt expense is estimated at. Okay, so really what you're doing is you're going back and you're looking at.
So we're gonna do like 0.75 of 1%.
See, that one's a little tricky, isn't it? The first one you're doing percent
Yeah, I
of
went and looked at the book
sales.
for that one on the regular homework, and it was saying something like using a percent. That's why I couldn't figure out. I don't know what I'm doing.
Yeah.
0.005?
Is estimated at 1/2 of 1% of sales. So really it would be 0.5% of sales.
Yes.
Yeah. So on that one, when you're doing percent of sales method, it's not on the test because it just confuses everyone. Percent of sales method's not using accounts receivable. It's not like an allowance method, like using accounts receivable. It's not an accounts receivable allowance method. So you don't have to consider what's in allowance for doubtful accounts. So percent of sales, when you're doing an adjustment entry, you would just literally take 0.5% of 11,750,000 to get your adjustment down.
Half of 1%.
Yeah, so half of 1% is like 0.5% or half a percentage. I don't know why they word it so confusingly. Okay, but again, percent of sales method, it will not be on the test.
So
Okay, I was saying because that'd be 0.005.
but we're still
Yes.
taking into account the beginning balance.
Not on percent of sales. That's, yeah, percent of sales method, you don't have to consider what's in your accounts receivable or allowance for doubtful accounts because it's just going off of percent of sales. Sales is a temporary account. So we're only looking at a percentage of a temporary account, so account that has happened in this year.
So
It is a trick.
So it would just be 0.005 times.
11,750,000.
Yeah.
And that won't be in the test?
No.
What?
So on the other one, the aging of accounts, that's new.
Yes. Yeah, on B, when it says the allowance account before adjustment has a debit balance of 14,000, and they tell you what the estimated doubtful accounts is, that's when you would look at you would want to know how to do that on the test. So they're saying it has a 14,000 debit balance, and then they're giving you the estimate of 44,800.
And so you add that.
To get your adjusting entry, you add. Okay.
And then that's the answer.
Yeah, you're calculating the adjustment amount.
So that was that as an answer.
Again, I write out the T accounts so you can visualize it.
Yeah,
So do that. Bring scrap paper. Bring scrap paper for the test and write out your T accounts. Okay.
So if it has a credit balance.
Correct. Yep. Any other questions on chapter 8? Not too bad, right? Just remembering all. Yeah, I love percent of sales off just because it tends to like throw people off. You know, because you have to like read it 5 times and be like, oh my goodness. Okay, let's switch gears now and talk about chapter 8. 9. We just talked about 8. 9. Chapter 9. Chapter 9. Okay, so chapter 9. Let's go back. Okay, chapter 9. Chapter 9 is dealing with fixed assets. Okay, so when we get into chapter 9, we're going from current assets to long-term or fixed assets. Okay, so on fixed assets, I would know what a fixed asset is. That'll be an easy one, okay? So fixed asset, well, give me some examples. What are fixed assets? I heard a few. What? Long-term assets is another term for them. Good. So what are some types? Land. Good. Buildings, equipment, all of that. Yeah, property, plant, and equipment is another word for it, right? They like to give it like 4 names. So fixed assets, the big takeaway is they're tangible assets, right? You can touch them. And they are going to help us earn profits in our business, right? We put fixed assets in place to help us. We purchase fixed assets to help us earn a profit. Really all assets, right? All assets are meant to help us earn revenue in our business. So, you know, one of your multiple choice questions will truly just be about fixed assets, what they are. So tangible assets, property, plant, equipment. Okay. So that's the easy stuff, right? Then we get into the, you know, calculating, of course, like depreciation. So you will need to know the 3 methods of depreciation. Okay. Let's start with depreciable cost. Let's review some terminology first. What is the calculation for depreciable cost? What's the formula? And what does depreciable cost mean? Yeah, cost minus residual value. So know that. That might be a multiple choice question. Hint, hint. Depreciable cost is cost minus residual value. Okay? So just know that formula.
So then annual depreciation cost is that divided by useful life? No. Yes?
Yeah.
Yeah. Okay, so depreciable cost is cost minus residual value. Okay. If you remember, that's the full amount we're going to depreciate that asset. That's what that means, right? It's the full amount we want to depreciate it. And it's helpful to understand that, especially when we do double declining balance, because that's when things get wonky. And you guys know what useful life is, estimated useful life, right? What does that mean?
How long we're gonna use that?
Yeah.
How long that tangible life is going to be with you and the company.
Yeah, exactly. How long we're going to use the asset, how much it's going to help us be useful in earning revenues in the company.
Also taking the depreciation for the number of years to buy.
Yes, yeah, we have to know it in our calculations, right? So it's very important. Also, just know under useful life that you estimate that when you put the asset in service, okay? So when we go and put that asset in, when we purchase it and it's ready to use is when we determine the useful life, okay? So that's, we don't want to determine that later. We determine it as it's put into service. So just know that. Of course, be able to calculate depreciable cost. Well, if you have the formula, that's pretty straightforward. Also, be able to know what the straight line formula is. So what is my straight line formula?
Cost minus residual value over the useful life.
Very good. Cost minus residual value over the useful life. Well, another way you could look at it is cost minus residual value is depreciable cost, right? So you could, under your straight line, just say depreciable cost divided by useful life. Kind of interchangeable. So if you see that on the test, it asks you to choose what the straight line formula is. You might see it as depreciable cost divided by useful life. But it's the same, cost minus salvage or residual over useful life. Okay, it's the same. We're just plugging in a formula there. This is all like multiple choice stuff so far. So the other multiple choice stuff, I would know the difference between a capital and a revenue expenditure. You won't have to do any journal entries on those, but just know the difference between a capital expenditure and a revenue expenditure. What would be an example of a capital expenditure, or an explanation even?
Change the transmission.
Good, yeah, you have to replace a transmission. Okay.
So is that just like a?
Capital gives, life, right? Like add more life to the, equipment.
Yes, it'll either add more life or more value, or both. You sometimes both, but yes. Yeah, so it's like a major repair, right? It could be a major repair or an improvement. So like, you know, if I put in new flooring and I upgrade from tile to wood, you know, that's a capital expenditure. If I just replace one tile, that might just be a, you know, revenue, like a replacement. I'm maintaining, you know. But if I pulled up all this tile and put in wood flooring, that's a capital expenditure. So yeah, capital expenditure is anything that adds life or value to the asset. Okay. A revenue expenditure is just maintenance. So an oil change, spark plugs, yeah, things like that, filters, anything like that. Okay. So capital expenditures are going to be either major repairments, or, you know, like I add remote start to my car, you know, something that I'm adding to it. Okay, so just know that. And then the only other multiple choice I would look at is just knowing how fixed assets are presented on the balance sheet. Okay.
And how is that?
Fixed assets on the balance sheet are just presented as their cost minus accumulated depreciation. Okay. So you'll see fixed assets on the balance sheet. You'll see like equipment, less depreciation. Okay, so you're just showing, what is that? What is cost minus accumulated depreciation? The book value, good. Okay, so know that, book value. Oh. So assets are reported, long-term assets, fixed assets are reported on the balance sheet at their book value, or cost minus accumulated depreciation. Okay. Okay, so that's the stuff I kind of understand from Chapter 9 review. Of course, it may not be a multiple choice question, but you'll want to know the formulas for units of activity and double declining balance as well. Okay, so let's go over the hands-on stuff. I didn't try to complicate this on the test, okay? So I try to pick questions that I wanted you to understand without being crazy like the homework, okay? So one of your hands-on questions will be calculating depreciable cost. Well, again, if you have that formula in your notes, it's really very simple, okay? So I'm not worried about that one. One thing you'll see on the test is you'll calculate straight line depreciation. So you have your formula, depreciable cost divided by useful life. Okay. One thing you'll see that I thought was a little strange is they'll want to know the straight line rate of depreciation, which we normally only use for double declining balance. But it doesn't matter what you're using it for. Your straight line rate of depreciation is always 100% divided by useful life. Okay. So straight line rate of depreciation is always 100% divided by the useful life. So if it was 10 years, it'd be 10%. 5 years, it'd be 20%. Okay. So it's just the rate of depreciation, 100% divided by useful life. We use that in the double declining balance formula. Remember, we double that. But if you see it when you're calculating straight line depreciation, don't freak out, just calculate it. So again, you'll want to know how, to calculate straight line depreciation. That's the only one that you'll have to worry about a partial depreciation on, okay? So just look for one on the test where it's like, oh, I acquired this asset March 1st or April 1st or June 1st. Somewhere in the mid-year, but it'll only be on straight line. It'll only be 1 year. Okay, so for example, let's just make up an example. Hopefully I can make up even numbers. I really need to write down examples. So say we have an asset with a cost of $50,000 and a salvage or residual value of 10,000. I know that's high, but I'm trying to keep my math simple. And useful life of 5 years. Okay. Well, we know, again, we can easily calculate straight line depreciation, right? We would take cost minus residual over useful life. So a full year worth of depreciation would be what, 40,000 divided by 5? That'd be what, 8,000, is that right? Yeah. Okay. Well, what if I got this asset, I put it into action on, say it was, I purchased it on July 1st. That was my purchase date. How long will I have it in the business? In the first year? How many months will I have owned it?
5.
Is it 5?
I count, yeah, 5.
6?
Is this?
Yeah, July, August, September, October, November,
Oh, you
December.
count July, okay.
Yeah.
Useful life? Okay.
Yeah, remember when you're counting months of ownership, if it's in the first half of the month, we always count that month as owning it. And it will be like that on the test. They won't throw a tricky one at you. So if it's, so July, August, September, October, November, December. So I will have owned it that first year. I will have owned it 6 months. Okay. So how would I calculate how much to depreciate?
8,000 divided by 2.
Yeah, you really could, right? If it's half a year, that one's really easy. You can just divide 8,000 by 2. But in other words, if it wasn't super easy, you would take 8,000 times 6 over 12, which is 1/2 or 50%, which is 4,000. I made it too easy, didn't I?
That's how we take it on the test.
It won't be too bad. Just remember to always take it by the fraction of the year that you had it. So know how to do that. Know how to calculate units of output depreciation or units of activity. Okay. So let's look at that same example, only we won't look at a partial year. I don't know why I just used my hand. So say we could use it for 5 years, or the other useful life would be for 20,000 units. Okay. 5 years or 20,000 units. So units of output method, remember you have to calculate the depreciation per unit first. Okay. So your formula starts the same, right? You take your depreciable cost, 50,000 minus 10,000. Only under units of output, what am I dividing by? 20,000, my total activity. Okay.
And that gives that little small per unit, right?
Yeah, and again, I made it kind of bigger just because I knew I'd make it even. So 40,000 divided by 20,000. So this would be $2 per unit, which is high, but we'll go with it. Okay. So under units of output, I would take depreciable cost divided by total activity or total units to get a depreciation per unit, right? And then say in year 1, we used 4,000 to produce 4,000 units. Very good. I would take my $2 per unit times 4,000 units, and I would get 8,000. Oh, look, I matched up. Same as my other one. If year 2 were like 3,000, you'd take 2 times 3,000. Okay. So just have that formula, know how to calculate the depreciable cost, depreciation, the rate of depreciation per unit, and then the yearly depreciation. I think that one, it's pretty similar to straight line. You know, you're using the same structure. You just have to calculate depreciation per unit and how much did you use it every year. Again, on your exam, you'll probably just be like 1 year, you know, maybe 2 at most. I think it's usually just 1 year. No partial year. If you think about it though, units of activity, even if we had a partial year, because you're basing it on how much you actually used it, you don't have to calculate the month percentages. All right. So double declining balance, that's the fun one, right? Again, you will not do partial year on double declining balance. You will not do an end of the year either, where you have to worry about the book value, you know, and the residual value and all that stuff. So we'll keep it simple, right? So double declining value, we'll use the same format. So we have an asset that was a cost of 50,000, residual of 10, useful life of 5 years. Okay, double declining balance. What's the first thing I need to calculate? Straight line rate, perfect. So I would take 100% divided by 5. Well, that's easy enough, right? 20%? And then double it. So times 2, 40%. Okay, so I calculate my straight line rate, 100% divided by useful life, which is 20%, and then I double it to get my double declining balance rate of 40%. What's depreciation then in year one?
So be the 50,000 times the 40%.
You got it. 50%.
I thought it was just the initial cost for year one.
It is, which is the 50,000. Yeah, year one is the initial cost of 50,000 times 40%, which is
So
what,
that multiplied by 40.
Which is
20,000?
20,000.
What am I? Oh my
Oh,
goodness.
I was 100%, holy crap.
I was writing 50% times, I don't even know. You know, when you're like talking and writing, you tend to
Yeah.
write, but yeah, we'll just blame that. My multitasking isn't working today. Shocking. I can paint my nails and watch TV at the same time. Skill.
What matters.
It is. It's a very important skill. It's on my resume. Oh,
And you use that 20,000
Yeah.
to find the book value?
yes. So yes, that's the big thing. And I can't remember on the test exactly how if it has you calculate a year two. But if it did, no book, the actual formula is book value times the 40%, right? So our book value at year two would be 50,000 minus 20,000. Okay, or what, 30,000? Okay, we have to calculate our new book value. Well, book value is cost minus depreciation. So 50,000 minus 20,000, our book value at the beginning of year two is 30,000 times 40%. So year two depreciation is 12,000.
It is the same thing for each year.
Mhm.
Or for 5.
And we won't get down to the nitty gritty. Again, on the test, I know on your homework, when you got to year 5, you had to consider residual value, and you're like, da, 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 da.
But if you get to year 3, you have to add the 20,000 and the 12, and you subtract that from the cost.
Yes, you sure do. Or because this is your book value, now you could take 30,000 minus 12.
For that.
Yeah, either way. Yeah. But yeah, you'd have to recalculate book value and then multiply by 40% again. So the first year, it's just your cost, because technically your book value in year one is 50,000 because you have no depreciation. So in then year two, we take 50,000 minus 20,000 to get a book value of 30,000. So then year three, it'd be 50,000 minus 32,000, or 18,000 would be our new book value. Okay. Yeah. So again, kept it pretty simple. No partial year, no last year depreciation. I would know, I can't remember, I think I left it on there. Double declining balance is the only method where the formula doesn't consider residual value. Okay. You have to at the end, remember, in that last year, you can't depreciate beyond the depreciable cost. But you don't, that's why you have to look at that, because we don't consider residual value. I don't know why. It would just make it easier if we did. We wouldn't have to be stuck with that. But one last thing, and then we're done. The last thing you'll want to know is how to calculate a gain or a loss when you dispose of an asset. You won't have to do the big long journal entry or anything. I just want you to understand how to calculate a gain or a loss. Okay, so let's look at this asset, for example, since we're on it. Say we're at the end of year two. What's my book value at the end of year two? Well, that was at the end of year one, actually.
30,000 minus 12,000.
Yeah, so I'd have to, the end of year two is the same as the beginning of year three, right? So my book value at the end of year two would be 30,000 minus the additional 12,000.
What we're doing is finding how much for the depreciable cost, right? Or whatever it is, the
We're finding the book value to determine what we have it valued at, to determine if we made them.
Well, I mean, when we're multiplying by 40%, we're finding the depreciation.
Yes. Yeah, this is your like yearly depreciation. So debit to depreciation expense, credit to accumulated depreciation. Yeah. So book value, if we had depreciated this for 2 full years, our book value at the end of year 2 is 18,000. Okay. What if I sold that for 20,000? Very good. So to get a gain on the sale of an asset, it has to be sold for more than the book value. So book value is your determining factor. Okay. So I always compare. I got 20,000 cash for this asset. I have it valued, God bless you. I have it valued on my books as 18,000. So I made a gain of 2,000. Okay. What if I sold it for 15,000?
You lost 30.
I lost 30. Okay. So just use your book value. Anything we receive above book value is a gain. Anything less than book value is a loss. And you don't have to do, the disposal of an asset journal entry. I took that off. That threw people off. So it's on your homework, you practiced it. I want you to understand the concept. Okay, I actually finished with like 10 minutes left.
Yeah.
Woohoo! Any questions?
Test, Tuesday?
Test Tuesday in class, 2 pages of notes, front and back, scrap paper, calculator, or you can use the calculator on the computer. You'll still have access to the calculator in Cengage if you want to use it. Like I said, about 25, 26 questions, multiple choice and hands-on. Be good. You're ready. You guys are ready for this.
Yes.
I feel very confident because you guys ask me questions. It's when y'all don't ask me questions when I worry. Yeah, I'm like, nobody's asking me questions.